Good afternoon, everyone, and welcome to this webinar on financial analysis. Through this webinar, we intend to give you a brief outlook how to start with a financial analysis of a company. I am Atul Karwa, and my colleague Nisha Sankhala will take you through this.
Hello, everyone. Hello.
So let's start off with the webinar. So what is the first basic premise of fundamental analysis? The basic premise is that a share has a value because it pays a future stream of cash flows in terms of a dividend or capital gains. So according to it, the value of a share is equal to the present value of the future cash flows. So an investor buys a share with a view to get some returns from it in the future. So all the present value of that returns, if we discount it to today's price, that should be the value of the share. Now, dividends are a major source of cash flows for an equity shareholder. The dividend. Now, when does the company pay a dividend? A company pays a dividend mostly when it is profitable. So the earning capacity, so the dividend paid by the company is determined by the earning capacity of the company. Now, the earning capacity is determined by some fundamental factors. Therefore, to evaluate the value of a share, it is important to do a fundamental analysis of the share. The price of a share in the market may go up and down due to volatility, due to some liquidity concerns, but over a long term, its price should be near to its underlying value. It cannot be much different from its underlying value. Now, to start with the fundamental analysis, a traditional fundamental analysis begins with the financial statement analysis to evaluate the financial solvency of profitability of the firm. These statements are basically the profit and loss statement or the income statement, the balance sheet of the company, and the cash flow statement. Besides these statements, an investor needs to look at the firm's product line, what products it's selling in the market or services it is giving in the market, the economic outlook of the product, whether in the future the products will be growing, there will be higher demand or low demand. Is there a possibility of some alternative of the product coming in which would impact its demand? The industry in which the company operates. The industry might have a negative outlook in the future due to a slowdown. Like in the current market scenario, the steel industry, we are witnessing a slowdown because of the pandemic. Everywhere the capex plans of the company are being held back. The quality of the management, the brand image of the company, etc. Based on these growth prospects of earnings or cash flows, the fundamental analysis attempts to determine the fair value and intrinsic value of the company. So based on these factors, the analyst estimates what would be the future earnings of the company, and it gives a multiple to those earnings to determine its value today. There are various sources of information for an investor to get the data which he wants, but the most basic source is the company's annual reports and quarterly reports. And besides, there are other commercial database providers like CMIE, Capital Line, CRISIL, and RBI Bulletin, which can provide you with the data required. Now, for a company analysis, the most important financial statements are the income statement or P&L statement, the balance sheet, and the cash flow statement. Through these statements, we will work out some financial ratios, which would help to give you a view of the company. So some financial ratios are like a liquidity ratio, the leverage ratio, which is the debt equity ratio, the turnover ratio, profitability margins of the company, what are the returns of the company on the amount invested, and so on and so forth. So we'll start our analysis with the most important statement, which is the profit and loss statement, which summarizes the revenues, cost, and expenses of the company during a period, which may be a quarter or the annual results. It is one of the three financial statements. Every company issues the P&L statement. Every listed company has to issue a P&L statement every quarter. we need to compare the P&L statement from different accounting periods to know the changes in the various components of the profit and loss account, like revenues, cost, expenses. So we get a view which parameter is changing and at what rate it is changing. So this, after preparing a profit and loss statement, we can see the growth in every parameter. We can forecast the growth in the parameters, and we could come to know the future earnings potential of the company. Some of the important metrics which we get to know from the profit and loss statement are the growth rate of the company in its revenues, its gross profit margin, its operating profit margin, and its net profit margin. So we can compare these margins with the past historical margins, historical ratios of the company to come to know whether the company is improving or it's going down. We can also use these ratios to compare similar companies with that company to get a better view of the company in record. So this is an example of a P&L statement. We can see the P&L starts with the revenues of the company. So we have calculated that the growth of the company. Last year the growth was 13.2%, and this year it has been 4.4%. So we need to find out why the company has slowed down its growth, why the growth has slowed down for the company. Is this an industry-wide phenomena, or it has impacted just this company? So with this, we can get a view of the company, whether the company is able to grow at least industry rate or not. So from the net revenues, if we reduce the raw material cost of the company or the cost of goods sold of the company, we would get the gross profit of the company. Dividing the gross profit by the net revenues, we would get the gross margins of the company. This gives us a view how much the company, how much is the contribution of the raw material, and how much the company can cover its other expenses through the gross margin. Now, after gross profit, if we deduct the other operating expenses like selling and administrative expenses, employee expenses, R&D expenses, which are all important for the operations of the company, we would get the earnings before interest, tax, depreciation, and amortization. So this is the core operating profit of the company. So through the EBITDA margin, we come to know what is the company earning through its core operations before its depreciation policy and its capital structure. So from the EBITDA, we deduct the depreciation, the interest expenses, and we add the other income. So we get the profit before tax of the company, and we deduct the tax, we get the reported profit after tax of the company. So here we can see the profit after tax has reduced by 8.5% despite the growth in sales. So the profit margins of the company has reduced. This is because the EBITDA of the company has reduced while the fixed expenses like depreciation and interest expenses have grown. So this is a brief of how to analyze the profit and loss statement of the company. Now let us come to the balance sheet. A balance sheet of a company reports the company's assets, liabilities, and shareholders' equity at a specific point in time. Because of the changes in assets, liabilities, and equity, it is important to have a fundamental analysis and pay attention to the changes and trends between quarters and years. Balance sheet is basically a snapshot of what the company owns, which are the assets of the company, and what it owes to the other stakeholders, which are the liabilities for the company. Through the balance sheet, we can calculate certain ratios, which is the debt equity ratio, which gives us the capital structure of the company, and we could come to know whether the expansion of the company is going through debt or company is using internal accruals. We can get the current ratio of the company, which gives us the ratio of the current assets to the current liabilities. The higher the current ratio of the company, the better prepared it is to pay for liabilities due within the next year. Companies with high current ratios have a greater safety cushion in case the business drops off. Like in the current scenario, we are seeing a slowdown in business. Companies which have a higher current liabilities are facing a difficult time in meeting those liabilities. Combining the P&L statement, we can also calculate other important ratios like the return ratios, turnover ratios. The return ratios are important because it gives us a view of what the final shareholders are earning, uh, what the final shareholders are earning from the investments of the company. So this is an example of a balance sheet of a company. First of all, we have sources of funds, which are basically the shareholder funds, which includes the capital which has been subscribed by the shareholders, and the retained earnings, which are the reserves of the company. And then we have the borrowings of the company. So these are basically the sources of funds through which the company gets cash to invest in its operations. And on the other side, these are basically the liabilities of the company. And on the other side, we have the application of funds, how the funds which have been sourced are being used by the company. So we have a net block which includes the fixed assets of the company. We have capital work in process, which is the ongoing fixed assets which the company is planning and which the company is investing into a new plant or new asset creation. Then companies which are having surplus funds invest in other companies, so we get a long-term investments of the company. So these are basically the non-current assets for the company. Then we have current assets, which includes inventories, datas, uh, short-term loans and advances, and other current assets. From the current assets, we reduce the accounts payable or the creditors and the other current liabilities, which gives us a net current assets. So this is how we need to prepare a balance sheet of the company, so which makes the analysis of the ratios easier. And now we come to the cash flow statement. A cash flow statement is basically a statement that summarizes the amount of cash and cash equivalents entering or leaving a company. It measures how well the company is managing its cash position and how well the company is generating cash to pay for its debt obligation or to make a new investment or to meet its operating expenses. A cash flow statement is different from the profit and loss and balance sheet statement, as it does not include the amount of future revenues or expenses. Nowadays, most of the company follow the accrual method of accounting, in which once a product is sold, the revenue is booked. But in a cash flow statement, only when the cash is received for the sale that the revenue is booked. So in that sense, it is different from P&L and balance sheet because it only considers those items where there is a cash, where there is incoming cash or there is outgoing cash. So anything future expenses of the company which are yet to be paid is not included in the cash flow statement. Now there are three major components of a cash flow statement. The first is the cash from operating activities, cash from investing activities, and cash flow from financing activities. The cash flow from operating activities converts the net income from accrual basis to cash basis by adjusting all the non-cash items, future income or expenses of the company, and changes in working capital. So this gives us a view of what the company is earning through its cash flows, through its operations. Then comes the cash flow from investing activities. This section captures the capital expenditure of the company and any long-term investments. Whenever the company goes for an expansion, it needs to buy land, plant and machinery. So that's a long-term investment. That's a capital expenditure of the company. So any expenses made on that front is captured in this cash from investing activities. And the next part is the cash flow from financing activities. This section captures the changes in the shareholders' equity and long-term liability. To meet its expansion plans, sometimes the company needs to raise funds. So either the company raises funds through a equity issue or through debt. So whatever funds raised by the company or whatever repayment the company does for its past debts is captured in this segment. Although there are no ratios to calculate, but a detailed analysis of a cash flow statement is important as it can reveal many red flags, like negative cash flow from operating activities, which gives an indication that the company is not able to earn enough from its operations. So the future expansion of the company is in doubt. Increasing profit is not converted into cash. Uh, Many a times you might see that the company is reporting increased earning year over year over year, but the cash flow are not reflecting a increase. So this raises a red flag why the profits of the company are not being converted into cash. Operating cash flow is funneled into loans and advances. Many a times the company is earning a good amount from its operating cash flows, but it is expending those incoming cash. It is giving out loans and advances, which might be to related parties or some related companies. Uh, but it happens that if a promoter wants to take out cash, he uses this route, which needs to be written off in the future years. These loans and advances don't get repaid and needs to be written off. So this also raises a red flag whether if the operating cash flows are being given out as advances. Many a times the companies, to improve its profitability, profit margins, they capitalize operating expenses. So those expenses don't flow through the P&L and are directly taken into balance sheet. So in this way, a company might improve its profitability. Now, profit or net income, as measured by the rules of accountants, are subject to dozens of estimates, approximation, and hunches. But after all, cash is cash. You either have it or you don't. So that's why the analysis of cash flow statement becomes important. So this is the format of a cash flow statement where the reported profit before tax, and we are adding all the non-cash items and non-operating items. So we get cash flow, operating cash flow, which is the cash flow from operations. From that, we deduct the capital expenditure of the company. So we get the free cash flow, and any non-operating income investments are also deducted. So capex, investments, and non-operating income to combined together, we get the investing cash flow. Non-operating income is basically income which the company earns from its investments, from its surplus funds which it invests in for short-term purpose into mutual funds probably. And in the third segment, we have the financing cash flow, which indicates the interest expenses which the company is paying out, any capital issuance or buyback which the company has done, any debt issuance or debt has been repaid by the company. So we get all the parameters for financing of the company. So all these three segments combined gives us the total cash flow of the company. Now we come to some of the valuation parameters which we use to value a company. So first and the most used parameter is the price to earnings ratio. The price to earnings ratio, or the PE ratio as it is popularly known, is a value indicator used by stock market investors. It gives us an idea of what the market is willing to pay for the company's earnings. It is also known as the price to multiple or earnings multiple ratio. It signifies the relative value of the company shares in an apples to apples comparison. This is the most used ratio as it is relatively easier to calculate the P ratio. The earnings of the company are given in the financial statement, in the profit and loss of the company, and the market prices are available. So an investor does not need to do anything. He just needs to take the market price and divide it by the earnings per share, and he will get the P ratio. But we have to take care, different industry groups have a different P ratio. For example, if we take the FMCG industry or the retail industry, these are some of the sectors which get higher Ps due to the future visibility of the company and sustainability of the products of the company. While we may see the commodity stocks like metals and oils get very low Ps. Also, large cap companies get a higher P ratios than a small cap or a mid cap company due to its ability to withstand the slowdown better. So next is the price earnings to growth ratio. This ratio is the stock's P ratio divided by the growth potential of the company, growth rate of its earnings over a specified period of time. This ratio is used to determine a stock's value while also factoring in the company's expected earnings growth, and it provides a more complete picture than a standard P ratio. Then next we have a price to book value ratio. This ratio is used to compare market value of a stock to its book value. Book value is basically the net worth of the company. This ratio indicates whether you are paying too much for what would remain if the company went bankrupt immediately. As with most ratios, the ideal ratio differs from industry to industry, and it is not possible to pinpoint a specific numeric value of a good price to book ratio. Generally speaking, a price to book ratio of less than 1 is considered undervalued, while a price to book ratio of over 1 is considered significantly over 1 is considered to be a overvalued company. A price to book value ratio is effective in evaluating only certain types of businesses, specifically if much of the business assets are intangible. As in the case of many technology companies, the price to book value is not very meaningful. On the other hand, price to book value ratio can be useful for capital dependent businesses like banks. This ratio can also be used for companies with positive book values and negative earnings, because in such a case, negative earnings would render the price to earnings ratio futile. Then the next ratio we use to value a company is EV by EBITDA. It is a ratio to determine the total value of the company. This multiple looks at a firm in the way that a potential acquirer would be considering the company's debt. This multiple is calculated by dividing the enterprise value by EBITDA. Now, how is the enterprise value calculated? It is calculated by adding the current market cap, the debt of the company, minority interest, any preferred shares issued by the company, and we reduce the cash from the company. This ratio is useful for transnational comparison because it ignores the distortion effect of individual countries' taxation policies. It is also used to find attractive takeover candidates, since enterprise value includes debt and is a better metric than market cap for mergers and acquisitions. Price to sales ratio is another ratio which we can use to value a company. This company values the prevailing market price of a stock to per rupees sales of the company. It is typically calculated by dividing the market price of the company by the revenues per share of the company. This ratio can be effective in valuing growth stocks that have yet to turn a profit or have suffered a temporary setbacks. Many a times when the company starts, it would be having a sales, but profit would be some time away. So in such a scenario, we can use price to sales ratio to value the company. Also, sometimes the company has a exceptional loss due to which the price to earning ratios becomes very high as the EPS reduces. So in such cases also we can use price to sales ratio of the company. Another ratio which analysts use is the price to cash flow ratio. This ratio evaluates the price of the company relative to how much cash flow the firm is generating. The free cash flow approach is the most time intensive, it but it typically produces the most accurate results, which can be compared between companies. So to find out the free cash flow earnings of the company, we take the earnings before interest and reduce the taxation effect of it. We add back depreciation charges and we reduce the net working capital and the capital expenditure of the company. This is the free cash flow available to the equity holders of the company. So the advantage of using the price to cash flow is that cash flows are generally difficult to manipulate. So we get a better ratio for the company. Now Nisha would take over from you. Nisha.
So thank you so much, Atul. So after analyzing all this financial statement, you might have a question that can earnings be manipulated? So there is possibility that reported financial information may be managed or manipulated by judicious choice of accounting method and timing. There are many pressures on the company that affect likelihood of the manipulation, and these pressures can be reporting of ever increasing earnings, especially when the business is going through downtimes, meeting of analyst expectations, executives compensation based on earnings. So this could be the possible reasons. Now how earnings can be manipulated using this numbers. So they use different methods like depreciation policy, inventory valuation policy, then capitalizes of expenses, etc. So all this could be the possible devices that on the financial statements can be manipulated. So moving on next slide, we have a checklist for buying a stock. So investing is simple but not easy. Data shows that majority of retail investors lose money every year because they don't have kind of the time and research that required to analyze the company, and eventually they fail in valuating the company. So here we have prepared certain data points so that you can follow that and lesser your research time. So those are first is business history and future potential. So understand the business of the company well. Understand how businesses perform during bad times, and what is the future potential looking at the current economic situation. So one is that, then management quality. So there should not be a single information questioning the integrity of promoter or even director or management, because even good company can become bad if badly managed. So this is very important point. And next two point is promoter holding and pledging of shares. For this, we have prepared a separate real life example slides. So we'll discuss it in detail in a bit. The next point is debt positioning. Look for the companies with low debt to equity ratio. High debt to equity ratio leads to high financial cost, and that ultimately reduces the profitability for the company. But there are some exceptions for this. Like a company might need to incur a capex because their because their capitalization utility has reached at certain point of level, so they have to incur the capex, or they might need to add some products in their portfolio. So there could be few exceptions. Also, there are some businesses like steel, cement, where their inherent business nature is that they require high capital funding. The next point is dividend policy. So look for the company with high dividend yield, and it should also be increasing with high profit. As and when company is increasing profit, the dividend yield should also be increasing along with it. So this gives a certain bit of safety in the minds of investor, because they are constantly getting cash flow for their investment. Next two points is return ratio and valuation. So recently Atul has explained it well. So I'll just move to next slide. Uh, so yes, we shall see two real life examples covering two extremes of spectrum. One is Reliance Industry, based on the end of constant capex cycle and revenue recognition from Geo, and the other is Z, where the financial and the stock price contradicts two different stories. So, as evident in the table, the company entered in capex mode in somewhere around 2008. The gross block addition between 2008 and 18 was around 1.25 times of the total cash flow from operations earned during that period. So this was huge. The capex story ended in FY18, and just before that, the stock started moving gradually and become a re-rating candidate. 10-year, as you can see, 10-year return of Reliance between FY8 to FY18 was almost around 5%. So stock didn't move because they were constantly doing capexes, and there was no sign of earning that seemed. So investor bit worried, and the stock remained stagnant for almost 10 years. And then suddenly the stock doubled in FY19 because the capex has been ended, and the revenue started recognizing. So that was the case. Even recently also, Reliance has become darling of the street because of its debt reduction via stake sale. So as we all see, the Reliance has moved to its all-time high in a recent stake sales. So now it has become a net debt-free company. So that was the case. Okay, in case of Z, you can see that the business was working perfectly fine. The numbers were great. Everything was great. Even the future of potential for Indian entertainment industry was also looking bright. But because of promoters ever increasing pledging of shares, uh, uh, for using those funds to use in different business like infra and many other, this created the whole chaos. If you study the table, promoters pledging was rising to from 52% in March 18 to around 96% in September 19. So investor got worried because they might fear that the sale of pledged share might be in open market, and there could be a huge price fall. So, and eventually that has happened. The stock fell 80% in 1.5 years. So this was the case for Z. So this is our fundamental analysis basic presentation. I hope you have been this presentation might be helpful to you. Thank you so much.